Okay, folks, if I can ask you to take your seats, please. I know that last panel discussion was very well received because I know there were a ton of questions as follow-up after that session was completed. So here we are. I'm going to pass it over to Michael O'Keefe in just a moment, and he will introduce you to all the panelists here. But the main goal of this session now is to take all of the themes that were just discussed and try to translate those into some of the solutions that you have access to. So I want to ask you to keep an open mind and think through some of the solutions that you're going to hear about. And I know that all of our panelists will be here at the meeting afterwards as well, so if there are further questions, we'll take them. So please welcome back Michael O'Keefe. And Michael, I'll turn it back to you.
Well, thank you very much. Thanks for joining us. I would reinforce and reiterate, yeah, it's amazing when you see a session like we just had and then a crowd gather in front of the stage. That's usually a good positive indicator, so thanks for your consideration. What we're going to do, indeed, as Lorna said, is to translate or sort of shift our focus from strategy and investment themes in the economy to action and engagement with clients. And I'm joined by 4 colleagues today. I'll introduce them. Firstly, Ash Reagan on my left here is a member of the Ultra High Net Worth Investment Office. And Ash will represent basically the perspective of clients. How are the clients feeling today? And how should we guide them to be thinking about this environment in the context of their overall strategy? Chris Wolf, who heads the Ultra High Net Worth Investment Office and serves as CIO of both PBIG and that office, will be here, and we'll ask Chris to really translate some of the specific themes to ideas in terms of how to adjust and affect portfolios. I'm going to skip around. Tom Latta is here to talk about specific ideas. So we'll talk about how to access this information. But basically, Tom heads the due diligence organization, is a key member of my leadership team, and can get granular, if you will, on specific ways to implement some of these ideas. And finally, last certainly but not least, is Natasha Yo. Natasha is probably one of the most important people in our organization. She leads advice and guidance execution. And she'll talk to us later about resources and where to get some of the good work that has been done by the organization and how you can take that and, again, translate it to engagement with clients. And in fact, on that, what we're going to do actually is to start off with a quick video clip that describes some of the advice and guidance sort of architecture and collateral that we have to help you translate good investment ideas into action for your clients. So let's first roll that clip, please.
Investment Management and Guidance, or IMG, regularly publishes a series of implementation guides designed to give financial advisors actionable investment ideas and portfolio construction advice based on key research themes. These guides include a monthly RIC implementation guide that complements the monthly RIC report, the Investment Roundtable Quarterly or IRQ implementation guide published each quarter, and a yearly guide based on investment themes in our annual Outlook campaign. The implementation guides have recently been redesigned to offer a wide range of relevant and timely information in a simple, easy-to-use format. The first section of each guide features an overview of current investment themes. It condenses these themes into talking points, along with supporting graphs and tables, which may be used to deepen your knowledge of the themes and provide market background to enhance your conversations with clients. The next part of the guide provides implementation context to the investment themes. Each theme is described in greater detail, along with rationale for its inclusion in the guide and market background. This section also recommends how the theme can be implemented within the context of a well-diversified portfolio. This includes both the suitable location of an investment in a portfolio and, where appropriate, what we consider ideal weightings for sample risk profiles. The next section is a list of implementation ideas with total solutions noted at the top. Total solutions provide turnkey, diversified exposure to each of these themes. Individual investment ideas appear underneath the total solutions and, when appropriate, include mutual funds, separately managed accounts, variable annuities, individual securities, closed-end funds, structured products, and UITs and ETFs. For investors with more investable assets, the guide provides additional suggestions. The final section of the guide is an alphabetical list of the implementation ideas and includes a short section that explains the rationale for including each idea in the guide. All of the guides can be easily accessed from the IMG website, Business Daily, and the Advice and Guidance Resource Center. To download guides from the Advice and Guidance Resource Center, go to the Advisor Online homepage and click on the icon. The panel on the left of the Advice and Guidance Resource Center homepage has links to implementation guides from the most recent RIC, IRQ, and annual Outlook campaigns. Taken together, the guides provide advisors with a wealth of ideas and information to engage clients and prospects and identify new business opportunities. We encourage you to draw upon these valuable resources as you work to build your business and navigate the markets ahead.
So really, it's all about implementation. We're going to jump into a conversation now about that in the context of the themes and ideas that we heard from research earlier. We put together little crib notes, and here's the flow as we think about it. The first topic, as it's listed here, is ash on cash.
There you are.
Ash on cash, and really to get serious. In my mind, as I said earlier, clients are with us, and we're engaging with them around some of the toughest questions they have faced as investors. One of them being if they've been blessed enough to have raised cash over the last year, and they're sitting on some pile of cash, what do they do? So Ash, I want to turn to you. We've heard from research. You're with an FA and a client. Let's cut to the chase. What do they do?
Michael, in many of the reviews we did last year and this year, we discovered that many of our clients in those reviews, in fact, raised cash last year, 10 to 20%, some of them. It's ironic when our clients make the call to raise cash, it's perceived as being panic, throwing in the towel, and at best a market timing event. When you reposition the same action, when advisors, us, make that call, it can be legitimized as a very defensive, genuine asset allocation move to move a little into cash, not the entire portfolio, but the 10 to 20%. And that's what happened with some of our advisors last year. Now, in order for us to do that, and for us advisors to make it intuitive to make that call to cash in a very downward spiraling market, we need to legitimize and recrown cash as king, if you will, because cash is in fact king in certain circumstances. So for those of us in the audience, there are many advisors here who have foundation clients, endowment clients, nonprofits, who have very formal investment policy statements. I would in fact, or we would encourage them to add language to use cash as a defensive asset allocation move in a downward spiraling market like we had last year. Or acknowledge cash as an asset class with a sliding range, a broad range, so advisors can tactically move within that range in a market crisis like we had last year. So cash in many ways does become crucial. I mean, the terms cash is king, keep your powder dry is all cash related. So cash becomes a very legitimate asset allocation device.
So just to be clear, though, in terms of policy, we talked about endowments and foundations. Are you suggesting that the high net worth investor think about it from a policy perspective?
You'd be very surprised that some of our savviest investors, both in the private client space as well as in the endowment space, deliberately went to cash to the extent of 10 or 20%. Now, that's a lot better than a very emotional investor, if they were allowed to make the call entirely themselves, would have said, just sell me out and go to cash entirely. That is a stigma in the sort of the golden rules of investing. So we, the advisor community, makes the proactive call during the course of the year, after observing that markets are in fact going down considerably, is to make, as I said, an asset allocation maneuver to cash that would be much more intuitive and less of an impulse and less of an emotional panic.
Now, having a policy is really off the back of client profiling. I think we've all trained up in terms of the normal practice, right? It's to profile our client once, be done with it, move on. I think that's being challenged today. Why don't you talk to us about what it means to reprofile clients in this environment?
For the last 4 years, Michael, my colleagues at the Ultra High Net Worth Investment Office and my colleagues in ING and certainly my colleagues in the advisory and PBIG have encountered this issue about profiling. The legacy profiling standard is 1 in 3. You profile your client once at the beginning of the relationship. The new account form by default becomes a profiling mechanism, and it's usually 3 questions. What are your goals? What is your risk tolerance? What is your return expectations? That's fine. We don't have to change that. But just 3 questions alone don't client discovery make. That in many ways is like running or flying a big jetliner with just 3 dials. The client is a lot more complex today, and we know that. Everyone in this room will attest to that. They have liquidity preferences, they have duration preferences, they have social responsibility appetites, charitable intentions, trust needs, all beyond those 3 questions. So profiling needs to be expanded in the number of questions that we ask, and we have made at least a draft attempt at IMG to draft 10 minimum questions you need to ask in those interventions. 1. 2, the frequency of profiling. So just 1 at the beginning of the year is good, but last year was a perfect theater to indulge in what we call reprofiling. But then again, reprofiling is just a fancy term for just having that dialogue over and over again with your clients. But it's hard to do. It's over-advised, but very hard to do, because we as advisors in the advisor community tend to personalize a bad market. We almost think we're responsible for that bad market. So there is a speed bump to make that call and to have the dialogue with the client. If we make that genuine attempt, or maybe a hard attempt, to compartmentalize ourselves from those markets, then we'll make that frequency of profiling happen. Because the client is a constantly evolving animal throughout the year. First, his risk attitudes may be changing because of the markets. There may be client events, life events, divorces, marriages, deaths, births, that can change the attitudes towards risk or change the goals, which can go completely ignored if not reprofiled. And finally, our clients are not static. They are out there, they're dynamic, they're moving, they're traveling. They come back from these travels with convictions, ideas, tactical convictions, which cannot be captured in a portfolio if we don't reprofile them. So is a quarterly reprofiling an overkill? Maybe. How about twice a year as a baby step to go back and reprofile on objectives, risks, and ways to move the allocation?
So it really can be almost viewed in some ways as part of the annual review, a regular review with a client. I think one last question for you, Ash, and then I want to turn to Chris and get specific here. Rebalancing has been on everyone's mind, right? So we saw obviously just very difficult returns in the markets. People are out of balance, perhaps relative to their long-term asset allocation. What's our guidance today?
You know, the good advice, the legacy advice is you rebalance because you take the emotion out of the whole act of rebalancing to your allocation. If there's a drift in your asset classes, you rebalance them because you believe in the reversal to the mean theory. Great advice. But try telling a client that when there are falling knives in 2008. There's a huge behavioral barrier that prevented them from rebalancing. In fact, they went through rebalancing paralysis. Our advisors did too, along with us. So we did not rebalance, especially if there was a 70-30, 80-20 mandate in favor of equities. It's catching falling knives. However, 1 year of no rebalancing or deferred rebalancing does not violate any golden rule of investing, in my opinion. If you have a very established discipline of rebalancing, deferring rebalancing is all right. However, if you write into your expectations with the client that calendar rebalancing is not the only kind of rebalancing, there's life event rebalancing, like I mentioned before, clients go through life changes, that can trigger rebalancing. Market events or asset class specific events, like hedge funds closing gates for redemption, can cause reviewing that particular asset class and rebalancing that particular asset class. So several ways to mandate that right at the beginning of the relationship can make rebalancing much more intuitive, not as impulsive, and it's all right to defer, is sort of our view.
So an underweight to equities, though, I have to say, is there's that basic tenet of rebalancing. It's okay to rebalance, but one has to look at the question: has the market bottomed or not? And from a timing perspective, how do we connect a view of the equity market? We just heard about that from research to the rebalancing question. So, Chris, again, you guys are often with financial advisors, facing off with clients, answering that tough question.
I'll pick on something that Ash said about rebalancing, reprofiling. I mean, the objective of all that is really to align the portfolio risks with the client's risk tolerance or kind of how they see things and their objectives. 2 things I think help answer that question. We'll tie it back to the market bottom. The first is, as many of you have seen in the presentations the last day or so around enhanced allocation, the array of risks that are available, and I say that in a positive way, the opportunities that are available to rebalance portfolios, particularly for clients that have stayed engaged and kind of came down and came back up. particularly on the back of this rally, if it was the bottom, is a very strong one in my judgment. And we heard a lot around commodities, real assets in particular. I know Tom will touch on that, but that to me looks like a fairly strong one. And I think about tying that to the market bottom this way. If it really was the bottom and reflation is very successful, equities won't go up in a vacuum. There'll be other things that move as well, things like commodities, real assets that would have to participate if this economic reflation is strong. I think the second point I'd make about this is that for clients that are heavy in cash and are looking for, they made a great decision, they've got to make another one soon, which is to get back into markets. I think what we have passed is the peak in fear. The research teams put together an interesting set of proprietary indexes, one around financial stress. And if you follow that kind of stuff, you know that it peaked back in March 10th, I think, or 11th was the day, just after all the news around bank nationalization and whatnot. But my point is simple, is if that peak is passed, we've seen a lot of this reflexive rally, I think, be the result of that peak, the reduction in fear, the return of risk appetite. You heard Hartnett say that. But it doesn't mean pile all back into equities. And I'll close the point this way about the bottom. We often think of rebalancing and kind of investing as compositional. I have to have 60% in equities or 70 or the number, kind of like that sleep number bed thing. What I'm getting at is there are a range of risks that should behave the same way. You may want to think of risk rebalancing. Are there other opportunities, say, in fixed income markets? We heard Jeff Rosenberg talk about some. Are there some in real assets? Are there some in even moving towards hedge funds or hedged equity strategies? And a lot of those, at least in our way of thinking, look like very strong implementation ideas that avoid the question of, is this the bottom? Are we trying to time it? And let us talk more broadly about matching risks to client objectives.
It's very good. I want to, through the morning and after thinking about some of the content from yesterday, there's a point I wanted to really try to drive home in this segment. And it goes like this. When we talk about enhanced asset allocation, and you hear about the opportunity to invest in real assets and the opportunity to diversify perhaps into alternative investments, the anchor, the core of that guidance is strategic. It's long-term. The diversification benefits long-term of allocating clients' assets proportionally to those parts of the overall markets. I think what we're hearing today is on top of that benefit from putting cash to work, where is there good valuation, that real assets is a segment that really serves two purposes. We see a bit of bullishness in that segment. We heard from a couple strategists today. And so I think that's critically important. And then again, the long-term diversification of that. Now let's shift and Tom, get very specific. So when we talk about a real asset portfolio, what guidance are we offering around that type of portfolio construction?
Sure, Michael. And this guidance really can be viewed in detail in the last RIC implementation guide, where we spoke and presented material on enhanced asset allocation. When we provide the tables across the risk profiles and then begin to approach a granular kind of examination of the real asset class, the real asset class. So within that, we basically approach it by creating a benchmark. And that represents some components that were part of the last discussion with the research analysts. They are 55% to the real estate asset class, and we really think about that from a global perspective. The second place that we would look to as a building block of a real asset exposure would be the commodities market, and that's about 35%. And then finally, about 10% in the TIPS asset class. So that's a very specific portfolio construction in real assets. And as we work through that particular allocation, we have the different risk profiles that show the appropriate allocation to that sub-asset class in a fully diversified portfolio. Michael, we worked on from there to kind of discuss the specific vehicles that might implement each of those sub-asset classes within real assets.
Mm-hmm. So again, just reiterate the importance of these implementation guides and being able to refer to them. Tom, let me stick with you, and we touched on this briefly, but again, we're facing another sort of decision we're facing is around credit. And so on one hand, we can invest in individual securities and make that call ourselves in concert with our clients. Another way to sort of play that trade is to go to either mutual funds or managed portfolios. So talk to us about if there are particular funds or managers that you would think about guiding people to that are cognizant of this trade, conservative now, waiting for a good turn in terms of moving into the credit space?
Sure. Well, and I think Jeff foreshadowed this a little bit by talking about core managers. So we could propose basically approaching the corporate question or the credit question in two ways. One is to approach it by buying basically a diversified active management strategy that's going to go across the sectors that are basically in what used to be the Lehman aggregate, now the Barclays aggregate. That includes the structured asset class categories of mortgage-backed securities, commercial mortgage-backed securities as well, corporate investments, investment-grade corporates very specifically. In these indices, there are not allocations to the high-yield market, and also the treasury and agency sector as well. So these managers basically manage against this index and will overweight and underweight the various sectors. I would point to a good example of a core strategy that has the right characteristics right now kind of to participate in would actually be our partners at BlackRock. So the BlackRock Total Return portfolio has about a 21% allocation to corporates. That's slightly higher than the 19% allocation in the index, so that's an overweight there. But they're also really very much experts in the structured asset class kind of categories where mortgages and commercial mortgage-backed securities make up 40 or 45% of that index. And as Jeff mentioned, that's another way to kind of tackle the credit question and start to get diversified ways to go into active fixed income strategies. The other thing that we do is we'd look at dedicated strategies to corporates. So this would be up to you then to create a portfolio where you subdivide your fixed income allocation and you bought a dedicated corporate bond fund in the right proportion to basically have a modest overweight, again, to investment-grade corporates. Two funds that we follow and we like and have high conviction around are the Delaware and the T. Rowe Price corporate bond funds. And of course, Michael, with detail around those in terms of tickers, that would be available in the implementation guide.
Yeah, I meant to ask before, so I'm going to flip back to real assets for just a quick second. I mentioned in my opening remarks about a focus on solutions. One platform we're able to use and sort of deploy solutions on is UMA, what we call UDP. So real asset UDP, I think, is in the works. Can you just briefly describe it? And somebody asked me this yesterday. I wasn't sure the exact date when it's launching.
Sure. So in terms of real assets, I'll go just a little bit deeper into kind of an inventory of solutions. The first place we start, basically, we talked about the index. We created a discretionary portfolio in the UMA platform and also make it available as a model in the MLPA platform. So actually you can see kind of transparently the weights and managers we selected, and you could go build this yourself. But in the UMA platform, we've created on a discretionary basis. Its construction matches the index. So very much you're getting guidance in terms of enhanced asset allocation. We've created a discretionary solution that matches that exactly. So the 55, 45, 10 weights of the various sub-asset classes. That solution we call a UDP, a Unified Diversified Portfolio on UMA. And that actually was made available in, I think, the third week of April. So that's available now. That's an actively managed strategy. And over time, should we favor one asset class over another inside of that, say commodities over tips or real estate over tips, we could change the weights and actively manage that strategy. So that's going to be a discretionary portfolio that's a turnkey solution. Within the sub-asset classes, in real estate, in tips, and also in commodities, we have specific vehicles that are fully covered in terms of due diligence that we offer to you as ways to implement these sub-asset classes. So the Credit Suisse commodity mutual fund, it would be in the commodity side. PIMCO and American Century have tips products that we follow and have conviction in. And then also on the real estate side, we're basically looking at a globally diversified portfolio of REIT open-end mutual funds. And you would see Dryden and ING among our favorite implementations there.
Thanks. I want to anchor on one final topic in just a minute or two. Chris, in enhanced asset allocation, you see more granular guidance around AI. Obviously, as it relates to Gates, liquidity, and the industry generally, 2008 was a very tough year for that category. Overall, I think our platform did pretty well. But can you just talk a little bit about the guidance and specific views you'd offer on AI?
Yeah, so with respect to alternative investments, so three things I'd make relevant to this discussion. The first is I think it's important to start thinking about it as three separate areas, not one blob with clients. So it's hedge funds, it's real assets, and it's private equity. They do have distinct characteristics and risks, and I think they're important to consider how they fit with the rest of the assets in the portfolio. The second is, as Michael alluded to, is the performance around hedge funds was as we would have expected last year. Broadly speaking, hedge funds did very well on a relative basis. Our expectation shouldn't be that they go up when the stock market goes down 38%. So in terms of profiling clients and the way Ash was mentioning some points earlier, I think it's important to note that AI has a role in terms of risk reduction. And for those of you that attended the EAA session yesterday, we highlighted this. And I think the third piece is that as you've seen or will see in the implementation guides, we're talking a lot about AI as a risk management tool. And I'll say it this way more specifically. Hedge funds and hedged equities. Hedge funds for qualified clients and then hedge equities in the mutual fund space are a key component to rebalancing risks across asset allocations in this environment. And I think that fits with a broader theme of diversification. We've all lived through a period where correlations have risen to very high levels across all sorts of asset classes. And what you hear from us as far as advice and guidance has been focusing on diversifying those risks, largely because what we hear from research and strategy is you can ride the equity roller coaster or you can think about ways to diversify the risks in portfolios. And by the way, that includes income. So a lot of the things that Tom is talking about hit this notion that clients with big cash portfolios, single bond managers, and diversified but down equities, that's a tough place to be in. Your call really is cash to equities, and we're saying time out. You can think about fixed income strategies, credit strategies, as well as real assets that broaden the risk palette that you're using to discuss with clients, and we think represents a stronger solution in this type of environment.
Thank you. Natasha, I'd like you, if you can, to reiterate and summarize some of the resources that are available to the group here today in terms of guidance.
Great, thank you, Michael. And all this great discussion does inspire action, and if action positively influences the client experience, then that is a win. So the question remains, what resources are available to you, the advisor, to impact that client experience? And that's what I'll be addressing. And don't forget that old adage, if you just take away one or two things from this discussion, then that's a win for you and the client. The most important thing we should address up front is where can you access all the resources for you to act upon, action, and implement? The answer is the Advice and Guidance Resource Center, the Business Daily, and the IMG website available through the Business Daily. In front of you, you have a one-page handout. On the flip side of that handout is a snapshot of the advisory homepage with a pull-out for the Advice and Guidance Resource Center, Business Daily, and then the IMG website. I will overview for you just a sampling of all the tremendous advice and guidance and the wealth of resources you have available to you. But please, I encourage you to go to these websites to explore for yourself. Firstly, there's the Investment Roundtable Quarterly Implementation Guide. IMG develops a series of implementation guides which puts these investment themes into context and then offers specific fulfillment recommendations for you to act upon these investment themes. The Featured Funds Guide. We will be retiring the Investment Recommendations Matrix and replacing it with the Featured Funds Guide. The Featured Funds Guide represents IMG's highest conviction mutual funds based upon IMG's rigorous due diligence qualitative and quantitative process. On the side, for more about this due diligence process, please visit one of the breakout sessions we'll be having this afternoon. The video pod. We all viewed the video pod earlier on this session. That is available for you on demand to review with your teams on the Advice and Guidance Resource Center. Profiles. IMG produces profiles for both managers as well as our model portfolios. Profiles offer in-depth advice and guidance, again, on the qualitative and quantitative due diligence and portfolio construction within IMG. White papers. We have a wealth of white papers for you. One white paper I do want to highlight is the white paper around the value proposition of the due diligence manager selection process and portfolio construction. Excellent intellectual capital for you to leverage in both prospect and client meetings. Market focus. Excellent resource for you to leverage for your client reviews. The market focus essentially captures economic and market data for the prior quarter, therefore putting your investment review within context of what's been going on in the markets. And finally, monthly talking points. These talking points are proactive advice and guidance for you to basically proactively pick up the phone, reach out to your clients, and engage in meaningful conversation, taking out the emotion and replacing it with rational discussion. All these resources and more are available for you in the Advice and Guidance Guide. It's essentially a reference piece for you, available on the websites, but please pick up a hard copy in the IMG breakout sessions. And last but not least, there are teams of experts ready, willing, and able to partner with you to come up with wealth management solutions. Firstly, Melissa Leonardo, who heads the Portfolio Strategies desk. The PSD desk is a team of dedicated experts to partner with you on portfolio construction and implementation across all asset classes and products. And you've already heard a lot from Lorna Sabia, who heads the Americas Distribution Group, a team of specialists, both external and internal, for you to leverage for portfolio strategies and product utilization.
Natasha, thank you. We're coming down on our time here. I'd like to close by asking some of the folks up here for key takeaways. So brief, concise, to the point. Ash, key takeaway.
Review, rebalancing. My encouragement to our advisor community is to personalize the top, automate the middle, meaning have diligent discussions with top 20, top 30, and then through email or through any other media and all of the resources that you just saw Natasha talk about, automate the middle in order to make that connection with clients.
Chris.
Look beyond the numbers in rebalancing. It's not just about going back to 60-40. There's a wider range of risks that we think are available and belong in portfolios.
Natasha.
You're not on your own. Leverage the wealth of resources available through the Advice and Guidance Resource Center, Business Daily, and IMG website.
Well, thank you very much. I think Lorna has a couple final comments. I'm personally late for a plane, so as she walks up, I'm going to scoot off. But thanks, everyone, for a great session.
Thank you to Michael and all the panelists here. I think I'm hopeful there's one takeaway that you probably haven't heard articulated as boldly as I'm going to articulate this. But IMG, for all of you, is your competitive advantage. And it's not just in the last handful of years that it's the number of resources, the number of folks on the team. It's not just that. It's the fact that as you get to know these individuals, they want to win just as badly as you do. And I would encourage you to reach out to our investment partners. They're all here with us at this meeting. They can give you great perspective as to what is happening at other firms in the way of supporting you, specifically on the topic. So once again, my thanks to all the panelists here. We're going to have you head out to a 10-minute break. You have 2 breakout sessions. We'll meet back at the Tuscany room for lunch at noontime and meet back here at 1 o'clock. I'm going to ask you to grab all of your belongings and take those with you. So have a great time at the breakout session. Again, my thanks to the panelists.
Wanna tell you